Discover the tips and strategies that will help you achieve your retirement goals. I'm your host, James Knoll, and this is the podcast dedicated to helping you retire well. It all starts right here on Ready for Retirement. Hi everyone, welcome to another episode of Ready for Retirement. I'm your host, James Knoll. A lot of times when we talk about investing, we're talking about long-term investing. Okay, how should I invest for retirement? How should I invest for 10, 20, 30 plus years away? And that's important. And that's something that, of course, we should talk about. Sometimes it's all we talk about. And what we don't talk about enough is how should you invest when it comes to short-term goals? Maybe you're saving for college for a child or a grandchild. Maybe you're saving for a down payment on a home. Maybe you're saving for something that's not necessarily 10 to 20 years away, but you want to invest that money and you want to make sure that money is not only growing for you, but also that you can count on that money being there and that you don't lose money. So what we're going to be talking about today is how should you invest for a short-term goal? Short-term being anywhere, call it under 10 years. And what's the best way to go about doing that? So that will be the focus of today. And the reason or the way I felt this would best be explored is to run through an example. And the example is this. Let's assume that you come to me and I tell you that I have an investment opportunity for you. And there's 6 investments that you can choose from. I want you to listen through these opportunities and tell me which one you would select. Investment opportunity number 1, it goes up in value 53% of the time. Investment opportunity number 1, up in value 53% of the time. Investment opportunity number 2, it goes up in value or has a positive return 63% of the time. Investment opportunity number 3, it has a positive outcome or a positive return 73% of the time. Investment opportunity number 4, it goes up in value. It has a positive outcome 88% of the time. Investment opportunity number 5, it goes up in value at 94% of the time. And investment value number 6, it goes up in value 100% of the time. Which one would you choose? So just to summarize, number 1, up 53, number 2, 63, number 3, up 73, number 4, up 88% of the time, number 5, up 94% of the time, number 6, up 100% of the time. You probably don't need me to repeat that. It's very clear that number 6, investment opportunity number 6, is the best bet, right? Well, it's what I would choose, but here's the thing. Each of these investments is the exact same thing. All of them are the returns of the S&P 500. So you can say, James, how on earth can you have different outcomes with the same exact investment? Well, what's changed is the frequency. What changes the frequency that we're looking for those positive returns. So investment opportunity number 1, it went up 53% of the time. Well, that's the S&P 500, but it's specifically the S&P 500 daily returns. So 53% of the time they were positive, 47% of the time they're negative. So it's pretty much a coin flip, whether you're going to get a positive or a negative outcome. Investment opportunity number 2 that went up in value 63% of the time, well, that was S&P 500 returns over any rolling monthly basis. So on a monthly basis, almost 2 out of 3 months you can expect for the return to be positive, but a little over 1 out of 3 months, you're going to have a negative return. Investment opportunity number 3 that was up in value 73% of the time, well, that was over annual rolling time periods. So 3 out of 4 years on average, the S&P 500 is up. 1 out of 4 years on average, it's down. Investment opportunity number 4, that was up 88% of the time. That was S&P 500 rolling 5-year returns. So take any rolling 5-year return over the past 80, 90 years or so, 88% of the time it's going to be positive, 12% is going to be negative. Investment opportunity number 5, that was up 94% of the time, that is the rolling 10-year return of the S&P 500. Again, take any 10-year rolling time period, the past 80, 90 years, 94% of the time it was positive, 6% of the time it was negative. And then finally, the one that we all love, the one that's up in value 100% of the time, that was the 20-year rolling return of the S&P 500. Now, these are just historical numbers. I always have to mention that does not mean that we can guarantee that going forward. We certainly can't. But what we see is that the frequency in which we can expect positive outcomes is totally dependent, not so much on the investment, but on the time that we can remain fully invested. So why on earth does this matter? Why are we going through this exercise? I thought we were talking about saving for a short-term purchase. Well, it matters because what you can see is the longer the time horizon that you have, the more you can expect a positive outcome. And if you're trying to save for a short-term purchase, a home, college, a large purchase, you want to make sure that as you're saving and investing for that you can expect a positive outcome. We don't want to be in a position where we have our dream home that we want to purchase and we can't get it because the money we set aside is down 10%, 20%, 30%. So what this exercise helps to bring into perspective is it helps us to see what regularity can we expect to achieve a positive outcome. So if you're looking to invest, say, for a down payment or a kid's college, and that's 2 years away, you probably don't want to invest that. Sure, you can make a little bit of money, but the possibility of you losing money over that time frame, if you're investing in the S&P 500, which I'm using as a proxy here, you could very well be underwater 2 years from now. So is that worth it to you? Is it worth having a little bit of gain, a potential gain, but also having a potential loss? Now, if it was a 20-year goal, that loss doesn't matter 2 years from now. You just ride it out, you give it time, and it will recover over time if it's like we've seen historically. But if you have a short-term goal, your time horizon is now more finite. There's not the indefinite time horizon. It's not something that's for the future. It's for now. So that's why for any short-term goal, and by short-term, I'm going to, for the sake of this conversation, I'm going to say 5 years or less, you might consider not investing that. You might just keep that money in cash. No, it's not going to grow a whole lot for you, especially where interest rates are right now. It might not grow anything for you. But the more important piece is that it won't go down in value for you. The focus is likely going to be more on preservation than it is going to be on growth. If you're trying to save for a short-term or medium-term goal, but that, say, is 10 plus years away, that's where you're probably pretty safe investing that money. We looked at the 10-year rolling returns of the S&P 500, and it was positive 94% of the time. One thing to keep in mind, though, is this is just the S&P. If we start to incorporate other asset classes into that, let's say you also have some small companies, some international companies, some real estate, et cetera, that likelihood of a positive outcome increases from 94% up to 95, 96, even 100% of the time, depending on what asset classes you are investing in. And again, just because that happened historically does not mean that we can count on that going forward, but it gives us a really great starting point. So if you have 10 plus years until you want to invest, that's where you can really start to look at building out a diversified investment portfolio to get there. If you have between 5 to 10 years to invest, that's where you might want to look at other, I won't call them non-traditional investments, but maybe bond type investments, conservative type investments. Do you potentially own a mix of stocks and bonds for that time period? Because yes, the stock portion of your portfolio might not be up over that time period, but you own bonds because bonds typically perform differently than stocks. So for a 5 to 10 year time horizon, you might consider maybe a balanced portfolio. Maybe it's half things that grow, things like stocks, and half things that are more conservative, things like bonds, or a combination like that. So there's no perfect answer to this. What it's going to come down to is a few things. Number one, most importantly, is your time horizon. The longer that you have until you need your funds, the more and more it makes sense to invest them because you have longer for that investment positive return to be accomplished. Number two, it's also just going to come down to personal risk tolerance, your personal comfort level with risk. Let's say that you're investing for something, let's say it's a home, and you'd like to be in a position to buy a home in 3 years. Well, you will probably be up in value if you invest, if we're using the S&P 500 here as an example, but it's not outside the realm of possibilities to expect that you will be down in value after that time period. So this is where your personal comfort level with risk and even to an extent your degree of flexibility comes into play. Because if you want no possible outcome of having a down 3 years or being negative after 3 years, then don't invest. But if you're saying, you know what, yes, 3 years is my goal, I want to invest, and if the market's down or if this is not made me any money by that point, I'm flexible with when I want to buy that next home. Maybe I just delayed a year or delayed a couple years. If that's the case, and I'm speaking very generally here, and there's a lot of details, of course, you want to look at before you do this, then it makes more sense because you're probably going to have a good investment outcome, a positive investment outcome, but you are certainly not guaranteed a good investment outcome. So back to the question of how should you invest for a short-term goal, start with this just to simplify it. If you have 5 years or fewer until you'll need that money, for many people, it makes sense to use a money market fund or a high yield savings account. You're just not guaranteed a positive outcome with any investment over that short of a time period. If you're looking at investing in something that you might need in, say, 5 to 10 years, that's where you can start to think about investing. Do you invest in a more balanced portfolio into something that maybe isn't quite as aggressive as a fully long-term investment, but something that's going to hopefully get more earnings, get more interest, get more growth than the bank is going to give you? And if you have 10 plus years until you need that money, that's where you can start to think about investing in a more growth portfolio because you have time on your side. You can afford to go through some of the ups and downs, but ideally over time you start to taper that down a little bit. So maybe you start with one portfolio that's more growth oriented, then you gradually shift to a more balanced portfolio, to conservative, to cash, so that your time horizon is constantly in alignment with the investments that you have. So this isn't a perfect way. Of course, everyone is going to be different in terms of their risk tolerance, their flexibility, their needs for this cash, the time horizon that they have. But this is a general framework in which you can think about this. The more time you have on your side, the more flexible you can be, the higher the degree of risk that you're comfortable with, the more that you can look to invest those funds. And you invest because you can have your money now work for you. The shorter your time horizon, the less flexibility you have, the less comfort you have with taking risk, the more you should stay away from investing. Maybe even just keep money in cash. Or if you are going to invest, do so in a very conservative portfolio. But this is helpful just to think about, because when we're looking to grow our money, the first thing we should think about is, when do we need this money? What's my degree of flexibility, and how comfortable am I with the ups and downs of the market and potentially tying this money up into an investment between now and the time that I need the funds? So I hope that was helpful. Thank you everyone for listening. If you have not already done so, please subscribe to the show. Please leave a review. I always love getting reviews, and I love more people subscribing. It helps more people to find our show. And thank you as always for listening. I'll see you next time. Thank you for listening to another episode of the Ready for Retirement podcast. If you're enjoying the show, please subscribe and let me know by leaving a 5-star review. And as always, for a list of the notes and the resources mentioned in today's episode, you can find those at the Ready for Retirement website, which is readyforretirement.co. That's readyforretirement.co. And if you have a question that you would like for me to answer in a future episode, then you can also go to the Ready for Retirement website, readyforretirement.co. There's a page called Submit Your Question where you can submit a question for me to answer in a future episode. Thanks as always for listening, and I'll see you next time. Hey everyone, it's me again for the disclaimer. Please be smart about this. Before doing anything, please be sure to consult with your tax planner or financial planner. Nothing in this podcast should be construed as investment, tax, legal, or other financial advice. It is for informational purposes.